All right, so first and foremost, I really appreciate the showing that we had today. I know this is the first one that we're doing. I kind of had an inkling that we were going to have a lot of people interested in real estate investment, so I'm not surprised to see you guys here, but I still appreciate the support, and I just feel like it's something that hopefully we'll get a rhythm to. Today was kind of an interesting morning because I'm a mess in terms of organization, if you haven't noticed. And I literally had to go to the bagel place, and I had to go to the A&P or the Acme or whatever it is. I had to go to the grab Dunkin' Donuts for coffee, and I was just running around like a madman. So I appreciate you guys giving me a few minutes to set up here. Delegate is a great word that I need to embrace. Many of you have asked me about where we are and the relevance of the Paca Club and all of that. William Paca was the only Italian to sign the Declaration of Independence, so that's the relevancy of the name. And this is a club that I actually grew up coming to. My father was a trustee here for years. My mom was the president of the Women's Auxiliary. If you go in that back room, you'll see their names on all sorts of plaques. So this is a place that every Sweet 16 was here, and every random occurrence growing up used to come here. That said, I am going to jump into the topic today. We're going to do a deep dive into real estate investment, and this is not just the first portion of this. The majority of the morning is going to be spent with me kind of doing an explanation on really how to look at an investment property and make decisions on does it make sense or does it not make sense in terms of the numbers. I know a lot of you are afraid of how to actually dig into that. I know this because all the time I have people come into my office and say to me listen, I have this investor that I'm working with and I don't know how to guide them, or I have an investor that's on the buy side a lot. But on the seller side, I have people come in and say to me, more often than not, my seller, wants this number. I don't think it's worth it. How do I get them down on price? So I'm going to show you kind of how to explain to a seller exactly what, a property should be worth, how to explain to a buyer why it makes sense to invest in one property versus another, or for your own, personal finance, how to, actually decide whether it makes sense for me to buy a property or not. And I'm going to give you some real life examples that I've done in my life. So hopefully it'll be really something that's real and palpable. Before I do that, I need to get everybody in this room to understand why real estate is the best investment going. So I'm going to spend a good portion of, the first 20 minutes or so really going through and educating all of you. Many of you are more educated than I am in this department. You've been doing this for years, but you need to be able to speak it, because the reality is when you think about real estate as an investment, it's not just in a vacuum. Real estate is an investment, but it's also other investments and other opportunities that are out there. And why do they not put their money in the stock market? Why do they not put their money in the bank? You have to be able to speak to that if you're going to work with an investor or if you're going to be an investor. So we're going to get into that. If you have any questions, I want you to just shout them out. I don't have a microphone, so I'm being as loud as I can be. If you need me to be louder, just let me know. I got the people in the back saying I'm good, so I feel good about that. But openly, this is supposed to be more of a discussion. The first part's presentation. The second part, I do want to be more interactive. And so I'm going to ask you guys to participate, and you'll see interesting ways that we're going to do that. It's really just one exercise, and I'm hoping that it gets us where we want to be. All right? And this is something that's going to evolve, I promise. I say that it's going to evolve because this is the first one that I'm doing of these, but I do want to start to lean into investment more. We're going to try to do these monthly. I already scheduled this for next month, so I would love for you guys to join us if you like what you heard. All right? I just want to give you a quick teaser of a couple of things because I want you to understand the framework of what I'm trying to build. I think it's helpful for everybody in this room. First of all the YouTube videos for all the sessions that I do are live. I had my cameraman call me last night and bail, so that's why I'm doing this little stupid gizmo. But the reality is I try to get all of them professionally recorded, so there's a content library if you ever want to go on there and check it out. Sorry about that. For those who have never been I know a lot of people in this room have been to them, but I do Growth Mastermind once a month. If this is for wealth formation, Growth Mastermind is all about leadership and productivity. So if you want to help grow your business in real estate, this is one to check out. I know many of you have been. This is the next session, just so you want to, if you want to get it in your calendar now for Reinvested, it's going to be here. We're going to be here until we outgrow here, which might happen quicker than I was expecting. But the reality is like this to me seems like a kind of like a centralized location, and I'm going to try to keep it here for as long as I can. There's going to be more opportunity to do QR codes, so don't worry. This is just my Instagram, which I'm going to skip. I would suggest every person in here, if you want to get my content regularly, subscribe to my YouTube channel, and you're just going to get fed it as it comes out. So if you miss a class and you want to get the class, do not email me and say, can I get the recording? I get way too many emails, you're not going to get a response. But if you actually do it through this, you will get all of the recordings as they come out. Everybody always asks me that question, so I figured I'll just highlight it here. All right, so the biggest question that we're going to start with is, why should you invest in real estate? I did pull a portion of this presentation from a previous one that I had done. So if you've seen some of these slides before, I promise you it's going to change pretty quickly, within the presentation. But what I do want to start with is this, because this is to me, it is the starting point. And I apologize in advance. Maybe I don't apologize, I'm being honest about it. But we are going to talk about money, and we're going to be very real about money. I think sometimes people get bashful when you start talking about dollars and cents. I'm not that way. I think that the only way we all learn is to actually talk about real numbers. So there's no ego to any of this. It's just being real about what investments look like. Okay? All right, so let's just say we have $100,000. You could choose to put it in the bank. You could choose to put it into the stock market. You could choose to buy a house, put it into real estate. If you put it into the bank, on average, I realize that these numbers change over time, but on average, you're looking at 0.3% return. Most savings accounts are terrible. Approximately 3% on the high end. So if you go to some of these internet banks, so $100,000 will make you $300 a year on average, $3,000 a year on the high end. If you put it into a savings bond or something that's a little bit more of a higher interest, savings bonds are 5.33%, and that's the 100-year average. So you're getting $5,000 on your $100,000 if you leave it in the bank. If you haven't realized this, there's this thing called inflation. And inflation, I'm sure you all if you go buy bananas at the store, you know what inflation's like, or gas in your car. But the reality is you're not going to keep up with inflation. So the problem with keeping your money in the bank, this is an old school mentality, is if I put my money under my mattress or if I put my money into the bank, it's there and it's protected and everything. It's not. You're losing money. You're literally losing money because your money's worth less and less and less every year, and it's not keeping up with that inflationary, impact. So when people say oh, it's safe to put your money in the bank, it's the opposite. It's actually the most risky thing in the sense that you're losing money every single year. Yeah, it's safe, you know where your money is, but it's worth less. Understood? Excuse me. So let's just talk about the stock market for a second. S&P 500 average return is 10.7% over the last 30 years. I'm highlighting this because outside of specific stocks, this is the best return that you're going to get. So yes, you could put your money into whatever, Apple stock, and Apple stock could shoot off and go crazy, but Apple stock could also go out of business depending on which company you selected. So if you want to be safe and put your money in the stock market, the S&P 500, the small cap index, all those things, those are the way to put your money in the stock market and have it be safe. Because you're not going to have Apple, Google, Facebook, all these different companies go out of business at the same time. There's naturally going to be some that soar. There's going to be some that go down, but collectively you're going to get a return. The return, like I said, is 10.7% over the last 30 years. So every year you're going to make $10,700 off of any money, off of a $100,000 investment. Understood? All right. So we're going to pause for a second. Do we all agree that Wall Street's better than the bank? Yeah. Yes? Yeah. Okay. Can we all agree that putting your money in the bank is better than buying that handbag?
Yeah. No way.
All right. But the truth is like, you know, if you go out and spend your money frivolously, you can buy your handbag if you want, but like generally speaking, you know, if you spend your money on like stuff, like that's not an investment. So you could obviously put your money into a SEP IRA, and I'm not knocking that approach. I would recommend that every person in here think about that because there's a tax deferment piece to this. So if you haven't set up, that's one of the advantages of Coldwell Banker that I actually really love is when you, if you want to set up like a, you know, a SEP IRA account, it will pull money directly out of your checks every single time you have a closing. And it'll put it towards the stock market. And the nice part about that is it's all tax deferred. So if you haven't done that, look into it. I'm not knocking that approach. I think you should do that. But this is like, you know, kind of in addition to what I'm saying. All right. So why is real estate king? How much have New Jersey homes appreciated in the last 30 years? Any takers?
200%.
243%. You're close.
How many years is that? 30?
Last 30 years. And by the way, this slide in particular has not been updated for I think a year. So I'm sure that number's higher because we've all seen it even go up further in the last year. So 243%, for those of you who want me to do the math for you, that's 8.1% a year. Now, if you think about that, 8.1% is less than the 10.7% that we saw in the stock market. So the first thing that I would think is well, then put my money in the stock market, right? Wrong. Here's why. So this is the thought process: is Wall Street outperforms real estate? That's a big no. So there's a bunch of reasons why it does not outperform real estate, and we're going to go into that. The first is called leverage. So when you think about leverage, it's pretty simple. If you have $100,000 and you put it in the bank, you have $100,000 in the bank. If you have $100,000 and you put it in Wall Street, you have $100,000 of stock. If you have $100,000 and you put it into real estate, what do you get? $500,000, because you could put $100,000 down and get the bank's money to give you 80% on that money or more, depending on what you're doing. I don't like to over leverage, but basically you're able to leverage somebody else's money to buy a larger asset, a more expensive asset, with the money you have. Make sense so far? Everybody understands that principle, obviously? So 8.1% a year, but it's on leveraged money. You're getting 8.1% on the $500,000 purchase, not the $100,000 purchase. And if you think about that, like now your return is on money that you don't even have. It's a big difference. It's a monumental difference. It's why real estate, one of the biggest reasons why real estate makes more sense to invest in than anything else. Number two, how do we make money on a stock? And this is a key thing for anybody who's really interested in stocks. So there's really two ways to make money. There's dividends. So if you buy a stock that gives you dividend returns, like, you know, they pay you a percentage a year, which we'll talk about in a second. And then the other way is selling the stock. There's no other way to make money on a stock. So average dividend pays out 2 to 5%. When you sell your stock, what happens? Because your dividends is when you don't have to sell it, you're just getting a percentage back. When you sell your stock, what did you say? Taxes, capital gains. So that's the problem. There's two things that happen like that are, I would say, negative when you sell your stock. Is like one, you give this, you know, stock away, you're paying taxes. That's the first thing. So whatever the tax rate is, whatever tax bracket you're in, you're getting hit then right then and there. The second thing is you're losing the stock. Like you no longer have stock. You have the money, you don't have the stock. So you're naturally not gaining anything once you sell that stock. It's over. So how do you make money in real estate? Because it's a big difference. Appreciation. That's one of the things we just spoke about. So we all know what that is. Equity buildup. Anybody know what that is?
When the house gets equity. Right?
Well, so what happens is when you pay your mortgage, you're actually paying yourself because you're buying more and more. Like there's two pieces of your mortgage. There's one piece that's the interest. There's the other piece that's what you're buying is you're paying off the principal, right? So equity buildup refers to that piece that every single time you pay your mortgage, you're buying a little bit more of that house. You're building up equity. It's a forced savings account. Whether you like it or not, it's forcing you to save money because you're buying more and more of your own home from the bank. Make sense? The next one is interest deduction. That's the other piece when you pay your mortgage. You pay your mortgage. On one side, you have the equity that you're picking up, more ownership of the house. On the other side, you have the interest that you're paying to the bank, but you get to write that off because we're allowed to write that off on our taxes. So both payments that you're making, both sides of the same payment, I should say, are going towards a benefit to you. And like that to me is like something that's a big deal. Whenever, there's like any political movement against, people writing off their interest, that to me is like immediate red flag, vote against it. Because this is the American dream. Like the American dream is home ownership. Why? Because we're basically allowing people to, go against their taxes with what they're paying off in interest. It's a big deal. It's a really big deal. All right, so what else? How else do you make money in real estate? Cash flow. If you own you own a piece of real estate and it's an investment and you're renting it out, you have cash coming in. That's the whole point of being a landlord. And then the last thing is depreciation of the asset. I'm not going to do too much on depreciation of the asset. I will touch upon it. But what I will say is like every single time you have an asset, you own an asset, and we're going to do a deep dive on depreciation on one of these coming, sessions, because I'm going to go into cost segregation and all of that. I'm not going to go into that today, but that's a whole session in and of itself. But basically, when you depreciate an asset, like you're essentially, the government is saying you own, this building, let's say, and we will allow you. We know that building is going to over time, basically need to be updated. So there's a certain length of time that we're going to put on all of the components of that asset, and we're going to say like as that asset ages, you could write some of that percentage off on your taxes. So there's a schedule for it, like, 25 years, like depending if it's commercial or residential. And basically what you're going to do is you're going to write off a portion of that. If your accountant's not doing that on any investment property you own, you need a new accountant. Like the reality is like this is something that's like, it's afforded to everybody in here if you own investment properties, and you have to depreciate the asset. It's a big deal. All right, so we got appreciation of 8.1% a year. We have equity buildup. Every year we're paying off a piece of it. That's what we're getting. So this piece, if you look at like an amortization schedule, like you have the interest piece, you have the principal. Your principal is going to rise every year as you make your payments. That's more and more ownership that you have of that house. The interest deduction is the other column on that same schedule. So it's pretty simple to understand. You could know as soon as you buy, assuming you have a 30-year fixed mortgage, you know exactly what your interest deduction is. You know exactly what your principal equity, your equity buildup is the day you buy the house. Like those are known to you because they're fixed for 30 years. Cash flow is obviously rent. Depreciation, there's 39 years for commercial. There's 27 and a half years. I apologize, I misquoted the number, for residential. So that's the way that you're able to depreciate it. You take the entire, the amount of the home, not the property. So you have to remove the land because you can't depreciate land. But you take the amount of the actual, home itself. And then over time, if you buy it for $1 million, let's say, and the land's worth $200,000, that $800,000 gets divided by one of these two numbers, depending on what it is, and that's what you get to reduce or deduct every year, rather. So, appreciation and equity buildup, then you have these three things. These three things, the interesting thing about this is you have to sell the property in order to benefit from. Equity buildup maybe not, but we'll get to that in a second. Appreciation maybe not, because you could obviously do a cash out refi. But with the exception of a cash out refi, you have to sell the property for these two things. These things happen without selling the property. So let's talk about number 3, the third reason why real estate makes a whole lot of sense. Cash out refinance. So cash out refinance, it's a type of mortgage refinancing in which the borrower converts home equity into cash. I've owned my house for X number of years. I'm going to pull money out of it. They're going to give me a loan for the money that I now own, because let's just say that the bank is willing to do an 80-20 loan. Well, if I own 50% of the property, now I could get up another 30% of that property I could pull out in the form of a mortgage. All right. So that's something that a lot of investors use to like have more liquid funds, liquid cash to go out and invest, is they'll pull money from one property, they'll put it into the next. The coolest part about that is, unlike a stock, you now have the ability to not sell the property, but leverage the property further to go out and invest in more properties. It's a big difference between that and stocks. So something to just think about. When you sell a stock, what happens? We talked about that. But you don't necessarily need to do that to pull your money out of a home. You could pull your money out of a home, and here's the best part about it, is if you do a cash out refi, it's tax free. You're not getting taxed on that cash out. So years ago, when interest rates were really low, I went out and I actually pulled money out of my primary residence. And my wife was losing her mind. She was like, I don't want to do this. Why would we do this? And I said, Kristen, I love you, but trust me, let me explain it to you. And so she was like, all right, what? And so what I explained to her is I said, we could take out $125,000 on our house in our own equity. It's just money that we own of the house. We could take out, and we're not over leveraged. We put down 20% to start, and we just we built up a ton of equity and appreciation and what have you. I said we could take out $125,000, and it cost us $2,500 a year. That's the cheapest money we'll ever touch in our entire life, because interest rates are were so low at that time that I was like, all I need to do is I need to take the $125,000 and put it into some investment. I'm not going on vacation. I'm going to put it into some investment vehicle that gives me a better return than $2,500 a year. And I said, Chris, I could get a better return in a week off of that amount of money. Literally. 1 week's time with $125,000, I could get $2,500 back. That means 51 weeks of the year, we're basically making money. So the reality of it is you have to be smart about, don't over leverage yourself, but if you're smart about it, and if you make, good decisions about when to pull money out and when to leave it, it could be a very useful tool, and it's certainly something that you couldn't do with the stock market. Number 4, inflation. So we all know what inflation's about. We've been dealing with it. We spoke about it already. The price of goods and services goes up over time. It's simple. So the thing about inflation is when inflation hits, when it skyrockets, Wall Street gets crushed. Because the reality is when prices of goods and services become more expensive, people buy less goods and services, and naturally all of the companies that are selling goods and services, which is what Wall Street is, they all have less in terms of money coming in because people buy less when their money doesn't stretch as far. The exact opposite thing happens with real estate. When the expenses of the world go up, so does real estate. Because what happens is people, landlords, start saying, you know what, I'm gonna spend more money on, whatever, milk and eggs and, gas and what have you. I got to raise rent. And so naturally, what you've seen, if you looked at rent over time, it's like this. I mean, it never goes backwards. Very rarely, if there's a little hiccup of backwards, it's quick. I mean, the reality is anybody who's ever been a renter knows that it's going this way. So when you think about that, real estate is the ultimate hedge against inflation. I think about my parents. I love my parents. They're very smart people, but they weren't really investors. They were savers. They did some really smart things from a saving perspective. They bought real estate and they lived in their primary residence and they made smart decisions in terms of what they bought and all that stuff. But I think about them now and I think of baby boomers in general, that whole generation, basically retired and saved, and a lot of them had, some of them had 401ks, some of them had pensions. But it's a fixed thing. They all have fixed incomes once you get to a certain point in your life. And some of you guys in this room might be feeling this. Once you get to that point, if you don't own real estate and inflation hits, now the money that you have doesn't stretch as far. And now you're feeling the tug of this is uncomfortable. I can't live, I have to live within my means. Maybe I have to scale back my lifestyle. If you own a ton of real estate, you don't have to do that. The reality is if the more real estate you own, the more you're actually benefiting from inflation because you're making more money, and that money can then be used to go out and buy goods and services in today's economy. So if you're looking to like have a more comfortable life later in life, real estate's the answer. The price of inaction is far greater than the cost of making a mistake. I actually really love this because I'm going to give you an example of like a mistake that I made, quote unquote, and how it actually worked out to my benefit. And you know, we'll talk about that in a little bit. So does everybody understand why real estate is just a great investment?
Yeah.
Have I sold you already? Yes? Good. It's a room full of real estate professionals. So I hope so.
Self-selected group.
Yes, if you're not sold on real estate, then you probably should exit left. Before I move on, any questions about any of that, please?
Do you think real estate is a great investment in New Jersey today?
Absolutely.
Yeah. Ding, 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 ding.
I do. You know, I'm going to tell you, you guys, anybody who's been to Growth Mastermind and been to this session, you're probably going to be like, all right, I heard this already. It's good for you to hear it again. So I just picked a random market. I picked Montclair. So in Montclair, in the year 1900, real estate the average home was selling for $2,500. When you fast forward 50 years to 1950, the average home in Montclair was selling for $15,000. When you fast forward 50 years to the year 2000, the average home in Montclair is selling for $300,000. When you fast forward 26 years to 2026, today, the average home is selling for $1.1 million. Now, if you were a buyer in the year 2000 and you paid $350 for your house in Montclair, you would have been like, I'm getting ripped off. You know, these houses are selling for $300,000. Like, I'm overpaying. Are you? Because right now you tripled your investment and you didn't even finish paying your mortgage off. Literally, because you're 26 years into a 30-year mortgage, assuming you didn't refi, and you have a fixed payment on a $300,000 house, your house is worth 1.1 on average. There is no time in the history of life where it doesn't make sense to buy real estate in any market. The question is, how long are you going to hold on to it? And the question is like, is it the best investment for you today? Because for me, it's not whether I'm going to buy another investment property. I buy investment properties every year of my life. I don't care what the market's doing, up, down, I could care less. Like every single year, I have a goal where I want to have one buy and hold that I buy every year without question. I've done that for several years at this point, probably 10 years. I try to buy flips every year. Like now, flips are a little different, and we're gonna do a whole session on flips, not today. But flips are different because it's a short-term hold. Like short-term holds, you got to be really, really intelligent on because you have to buy smart. If you don't buy at the right number for a short-term hold, you have a problem. When you think about longer term investments, I'm going to hold on to it for 30 years. We're going to talk about what matters. This is the whole rest of this conversation is going to be about what matters for those type of investments. That's at the heart of what I'm about to talk about is buy and hold, not flips. Flips we'll talk about some other time. Understood? So the short answer is yes. All right. So any other questions before I move on? Because I'm going to go in a different direction.
When you do a cash out refinance,
Yep.
Can you write off that interest as well too?
Yes. Yeah. So when you do a cash out refinance, it's just think of like having a new loan, and the new loan you're still writing, you're doing the interest on. It's just resetting the loan that you had originally. It depends if you do like a home equity loan or there's different ways to structure it. But if it's a cash out refi, a true cash out refi, that's the way you do it. Any other questions, please?
So for the depreciation, you can only do the improvement value, not the land value. So how do you,
Correct.
so things here are really convoluted. How do you determine that? Who determines that?
The tax assessor.
So you have to go, because a lot of times they're underrated.
No, it's just the land
How
really
do you
doesn't change.
evaluate that?
Yeah, the land, like the tax assessment will say the land's worth $200,000. You have to just take that $200,000 off the purchase price.
Even
It's-
if you think that's incorrect, because they're all,
You're never going to be able to argue land with the tax assessor. You could argue the improvement value, and that's when people do if you go out and you try to get a reassessment, or if you try to get the value of your home changed, in terms of the tax assessment, you're not arguing the lands. They won't even listen to the lands. The land is a standards fixed thing. What you're arguing is the improved value, the building itself. You're saying the building's worth less than what I think you think it's worth. And here's why. You're not arguing land. Land is something that you're not going to be able to argue at all because it's just standardized.
So it's the tax assessor that determines that.
They determine it for the town, and honestly, it's pretty standard. Like it's not something that it's really hard to argue land.
Yeah, I know, yeah, but. that's
I'm not saying like
incorrect.
I'm not saying that maybe there's a way to do it, but I've never heard of it. Please.
Do you consider investing in other states? Because some investors I know don't like they feel the courts are very pro-tenant here.
Yeah.
And the cost of getting in another state can be a lot less expensive.
Yeah.
But I think you have to really know the state, like expensive.
Do I consider for everybody who couldn't hear
Florida,
it, would I
Pennsylvania.
buy in other states? I do own properties in other states. I own some properties in upstate New York. It's not tenant friendly, or I mean, it's not landlord friendly. Listen, I have
Florida,
my buddy. If
Georgia.
you ever heard like Cyrus speak, Cyrus, is from Orange County, California. Some of the most wealthy properties in the world are there, and he basically has been investing in like Muncie, Indiana, which is was like the meth capital of the U.S. So I'm not kidding you. The guy owns half the town. Like he just keeps buying properties and like. Would I suggest that you do that? Like, it depends on you. Like, I don't. What I've learned is I like to invest in things that I know. I like to invest in properties that are close enough for me to handle an issue. I don't want to have to fly to Indiana to like try to like find a handyman, like or get a phone call from like a plumber. Like that, I can't do this job, but like there's a leaking sink, and like now I gotta like go crazy. Like I just at a certain point, and it depends on who you are. I'm not knocking it. Like I think that if you are that person that I don't care, I want to put my money in real estate, and I can't afford to do it here, so I'm gonna do it elsewhere. Great, do that. But like for me, I care about quality of life. Like I don't want to be like stressed about trying to figure something out, 3 states away if I could avoid it. And that doesn't mean that I'll never invest in other places, but for right this second, I have a pretty chaotic life. I have 4 little girls. I run a brokerage. I'm sitting here doing this with you guys. Like, there's a lot going on.
Okay.
So I try to avoid that. Go ahead.
Michael, do you use property managers at all?
Property managers, I'm going to do a whole segment on like how I run properties because honestly, that's like a deep dive in and of itself. But I actually hire. I have the scale for where I am to be able to hire. Basically, we have our own property managers, so it's not like we're not like hiring some random company to do that. But I am going to talk about that a little bit in the rest of this presentation. Please.
So how much money are you investing from your savings? What's like, is there a safe zone for like how much you should keep?
I kind of think some of that's a personal decision, but what I would say for me is I'm never all in, like ever. I'm never get to the point where I'm like, oh my God, like if the roof fails, like I'm not going to be able to pay my mortgage this month. Like I think that's an idiotic approach. Hold on one second. So like for me, what I invest is like I want to make sure that I have a nest egg that's like could cover my expenses. Some people say like if you could cover your expenses for a year, I think that's kind of extreme for most people in life. I personally have pretty good job security. So like it also depends on kind of how comfortable you feel. Like if you're a top producing agent and you're selling 4 houses a month every month like clockwork for the last 10 years, like maybe you don't have to worry about that as much as somebody who's like trying to get to consistency in their business. So like, it just kind of depends on what your personal finance is and what you feel comfortable with. But for me, I invest most of my money in real estate. Like, I do have, 401k. I max that out. I do have savings and I'm very comfortable with my savings account. But like the reality is I don't want to keep a lot of money in the bank. Like I personally don't because it's doing nothing for me. Like I just have a nest egg in the bank and, operational expenses in the bank when I know that I have to I have to pay this mortgage, I have to pay this, contractor, those type of things. Outside of that, most of my money's in real estate. Go ahead.
Just to piggyback off of that gentleman's question, what are your thoughts on JVing if it's not like, hey, I don't use most of my savings account?
Yeah, so joint ventures, I have partners on most of what I touch. Like, and some people in here may say that that's a dumb approach in the sense that, like partnerships are a problem, and like, and listen, there's a lot of issues that come up with partnerships.
50-50 partnership?
Mostly it's not broken down that way, but yes, I've had plenty of 50-50 partners. I will say this, like for the most part, I prefer, if you're buy and hold, you better love your partner. Like love. you have to, you're married to them, it's hard to get out of some of these situations that you get yourself into. I'm going to do a deep dive on all of that at another session, because that's like a whole nother topic. But I will tell you that yes, I do joint ventures like all the time. For flips, I prefer it for flips, because for flips, you have one person who maybe the cash, you have the other person who's understands the how to work with contractors or is a contractor. Although I personally would not want to do this with a contractor. For any contractors in the room, close your ears. But the truth is what I don't like about, a lot of times people are like, oh, I want to link up with a contractor and I'm going to bring the money and they're going to do the job. Yeah, but then you lose a lot of control, because now that contractor, they could probably get the job done, but you have it in your mind that the only reason you're linking up with this contractor to do that, if you have the cash, is because you want that person to, do a good job, do it quickly, and do it cheap. And I just find that doesn't happen. Most of the time, they're like, oh, well, I'm the partner. They can't get rid of me. So I could charge what I want to charge. And it's well, what if I have to fire that contractor on the deal? You can't fire your partner. So, I think that there's a lot of issues that come up with that. I know some people probably protest and say, I have a great partner and it's the best thing in the world. Okay, good for you. For me personally, I just prefer not to do that. Any other questions before I move on? You guys gave me some time to drink water. I appreciate it. Go ahead.
Sorry.
No, you're good. I'll drink more water. Go ahead.
Do you have any thoughts about market timing and the possibility of buying on the crest of the market?
Good luck timing a market. If you could time a market, you're way better than I am. There's been so many times where these pundits are like, it's gonna crash, and then I'm like, continues up. 86 years now, I think is the number. I don't remember exactly, but I think in the last 85 years, the market has gone up all but 6 years. Think about that. So in all of our lifetime, the market has had 6 years where it's down. Are you really timing a market? You're going to wait for that. And by the way, one of those years were when interest rates were 20 something percent. 89, 90 in that range. And then 5 of those years were the Great Recession, where all hell broke loose in the economy. I'm not timing a market. Are there cyclical moves or seasonal moves within the market? Rather, there are. Again, not something I'm worried about, because I'm making decisions based off of the numbers and the spreadsheet that I'm about to show you. All right. Anything else before I move on?
What was that number? 86 years, it's gone down 6 times.
85 years, it's gone down 6 times. 5 years were the Great Recession. 1 year was, I want to say 89. I think it was that year. It's right in that range. And basically that was because, we had extreme inflation, interest rates skyrocketed, all that kind of stuff. All right. All right. You guys remember this from real estate school? There are 3 different, some of you guys don't even remember real estate school. So there are 3 different valuation approaches. Basically, there's the sales comparison approach, the cost approach, the income approach. Almost every person in here uses this on a regular basis. That's like a CMA. I'm going to look at the comps in the marketplace. I'm going to decide, what makes the most sense based on those comps, and that's how you make decisions in your career and how you guide your clients and all that stuff. And obviously, that's a great approach. It's not what we're going to talk about today. The cost approach is, what would it take to rebuild this property in today's market? That's great for if you're an insurance company. And you're trying to define what your costs are. It really has nothing to do with trying to evaluate an investment property. So again, not really what we're worried about in today's conversation. The income approach is where we're going to spend all of our time. And I'm going to give you 2 quick ways to think about income approach. And then we're going to decide which way you think is the best approach. and we'll go from there. So the first approach is cap rate. Cap rate, the formula for cap rate, don't get lost on all this because I'm gonna go through this quickly. The formula for cap rate is the annual profit divided by purchase price. That's a very simple formula. It's easy to figure out. It's like, how much am I gonna make off of this property? How much is it actually costing me? It's answering a simple question. How good is the property itself? Okay? Some more facts about cap rate. It ignores the loan. It's as if you bought it cash. So it's just evaluating the property. If this building were a vending machine and I owned it outright, how efficient is it at producing income? That's essentially what you have to think of it as. Like, don't worry about like all of the other factors. All you're looking at is like, how does it generate, cash for me? Why it matters, it compares one property to another, so it's a very easy way, very easy tool for you to look at this property versus that property and make a decision quickly. It helps value commercial buildings. That's an easy way to value commercial buildings. So if you're in commercial real estate, you've heard of cap rate, you probably use it regularly. And it tells you about the risk and quality of the income. An example of cap rate, purchase price of $1 million, annual income after expenses, $60,000, the cap rate's 6%. This property earns 6% a year on its own, regardless of how I finance it. Any questions about cap rate? You understand it quickly? Please.
Isn't cap, maybe I'm wrong on this, but instead of the purchase price, it's the market value, or it stands on the purchase price?
Well, it's purchase price because you're looking at it today and like, what can I buy this property? This is like evaluating a property today, like, am I going to buy it or not?
Correct.
So purchase price is like, what am I going to buy it for? That's the reason why it's that. I understand what you're saying, but like, we're just a snapshot at the time of when you're going to purchase it. That's what this is.
Are you sending us these slides?
No, but I'm going to give you a way to get them in a second. So cash on cash return. Annual cash flow divided by cash invested. That's cash on cash return. So cap rate's one, cash on cash return is the other. Annual cash flow divided by the cash invested. So it answers the question, how good is this deal for me? Just to go back 2 slides, this is how good is this property itself. This is how good is this deal for me. All right. Facts about cash on cash return. Cash on cash return is about you and your money. So the example is, it's the same property as before. The down payment and the closing cost is $250,000. The annual cash flow after mortgage is $25,000. Cash on cash return is 10%. My money is earning 10% a year while the bank's money is doing most of the work. Any questions about that before I move on? No? All right. So why do these two things move in opposite directions sometimes? Because you could have like, a high cap rate and you could have a low cash on cash return, or reverse. They don't always work like together. So these are examples of why that would happen. You could buy a low cap rate property, but you could get really good financing terms. And then you could end up with high cash on cash return. Alternatively, you could buy a high cap rate property, you could pay all cash, and you could have a lower cash on cash return. Why would that be? You have more cash in the deal, the percentage of what you're earning off of that deal is going to be less relative to the cash you have in the deal. Make sense?
Yep.
I know this can be really confusing, so I'm trying to give you examples of like the balance between those two things. So if you have questions, shout them out now, because otherwise I'm going to move from here and we're going to build on this.
Can you go back to the last slide before this?
Please. So cash on cash return, it's basically looking at think about it like this. I'm going to make it really simple. I put $100,000 in the bank. What's my return? I put $100,000 into the stock market. How much cash am I getting back at the end of the year? I put $100,000 into a real estate investment property. What is my return? If I get, if I put $100,000 in, I get $10,000 back. It's a 10% return. It's cash on cash return. So the cash you put in, the cash you get out. Go ahead.
So what I might be getting, if I am getting ahead, you'll just tell me. With the down payment plus, let's say, rehabbing cost, how do you calculate that?
So all goes into cash, the cash that you put out.
Okay.
Cash on cash return is how much money do I put into the deal totally. You have a question?
When you're calculating the cash out, you're doing it after your payments, correct?
No, it's your initial
You paid your,
investment after the initial
It's like the
investment.
profit coming back to you.
profit after
After-
your
after-
loan payments are made.
Correct.
Right,
It's
so
just
not
the
just
cap.
the mortgage, like the maintenance, the loan.
Yeah, this is after all
everything.
operating expenses and what comes back to you in the form of cash. That's cash on cash return. All right? Okay. So my question to you is, which do you think that investors care about more?
Return.
Oh, you got a pretty smart crowd here. Beginners focus on cap rate. Experienced investors obsess on cash return. So I know that there are people that are experienced that are like, I use cap rate every day. Fine for you, but it's not accounting for a lot that goes into a deal. You know, it's just it's a quick snapshot of like how do you make a decision on a property quickly. But like to me, like cash on cash return is everything. All right, so I'm going to give you a real life example, and we're going to go into the numbers. So I hope your eyes don't glaze over, but I promise you, if you stay with me, it will actually be pretty helpful for you to understand how to evaluate properties moving forward. This is a house that I bought less than 10 years ago. You know, it was like pre-COVID, so maybe it was 2018, 19, in that range. So this was the actual economics on this house. I'm going to go through slide by slide and show you the spreadsheets that I use, and we're going to talk about this. So 44 Madison Avenue, a few blocks from here. I purchased it for $415. I think it might have been $410, but it was right in that range. The acquisition costs, all I did, and I'm just going to kind of point some of these things out. So number one is purchase price. That's what you would fill in, whatever the purchase price is. If you are doing this is obviously in hindsight. It's a much easier conversation. But like if you're doing this for a property that you're considering or one of your investors is considering, by the way, I'm going to give you this spreadsheet, so I'm going to teach you how to use it. That's the whole point of what we're about to do. The thing is this, like, I'll give you a couple ways to consider this. I'm working with a seller right now, and the seller is saying my house is worth $800,000. That's what I want to list it for. What I would do is I would plug $800,000 into this, and then I would run all the numbers at $800,000 and then see what the return is going to be. And if the return is like negative 20 percent, like I would say, Mr. and Mrs. Seller, like I know you want $800,000, and they're going to be like, well, I make so much money off of this. I'm like, yeah, because you bought it at $300,000. Like, and you have to consider the fact of where you bought it and what your return is versus where it is today, and at $800,000, what that return would be. Good luck explaining that on your own without a spreadsheet. Because you could sit there all day long and you could try to tell a seller why their house is not worth what they think it's worth. But if you show them on paper, let me show you the actual numbers and what the return would be for somebody. Why would somebody put $100,000 to buy your house if they're going to get a negative 20% return on their house? Why would they do that? Like, and then the seller looks at you and goes, oh, I did it. Like, and I've done this a lot of times, so I know exactly what the reaction is. And it's an easy thing for you to sit there and have a conversation with them. Another example would be a buyer that's like, I know I want this house, like, but I want to buy it for 50% off. And you can show them, like, yeah, 50% off, like, your return would be 127%. Like, what return are you getting for 127% in the marketplace? You see how I could use it for both sides?
Yeah.
For you guys personally, and you're like investing, what I would do is like you could plug in different numbers on purchase price, and you could plug in different terms, like for like different lending terms if you have like different options, and it will change the formulas. That's how you use this spreadsheet. What I'm doing is, in hindsight, I'm giving you the deal that I made originally, and then we're going to go back and evaluate it. Understood? Mm-hmm. All right, so the 415 is just, I just plugged that number in. That's what the actual purchase price is. For acquisition costs, all I did was just take 2% of the number of the, basically the purchase price. Why? Because, closing costs are roughly 2%. Like, so that's what I did. I know some of you would be like, well, we're in real estate. I get a commission back. I get that. I did not plug those numbers into this. That was kind of like cake. But like you could plug those in if you want to factor in like what what commission you would get back and how it's going towards your down payment and dropping your cash on cash return. You could definitely use that. I did not for the purpose of this explanation. My loan, all I did was drop in like what percentage was my loan to value. So I got an 80-20 loan. I put down 20% on this property. The rate at the time was 4.5%. So that's, and that's what I bought it. This is like face value what I bought this property for, and truthfully, I did not buy it as a real estate investment. I bought it to potentially move into it and then change my mind after I owned it. So it kind of will highlight why I made some decisions that maybe I wouldn't have made otherwise. So that's number 4. So this is like continuing down that same page. If you notice, this is like what I'm putting in for like my numbers for purchase price and all that stuff. The next thing goes into really the costs of it. So the monthly payments, $3,000 a month. The vacancy allowance, do not put this at 0. Everybody in here thinks that every property they own is going to be 100% occupied all the time. You're wrong. It will be vacant at times. And so I'm going to give you a really easy example as to why it's vacant. I've been very lucky on this property. I have not had a vacancy for the entire time I owned it, like, which is a gift from God. But like the reality is like, think about this, like a tenant says they're moving out. You have to like put it on the market and get somebody in there. The chances of you getting somebody in there the day that they move out is very unlikely. Usually is going to be 2 weeks, a month, whatever it is. That's your 10% right there. So like that doesn't even account for the fact that if you can't get a tenant, that's a whole different conversation. I plug in 10%. By the way, just to give credit where credit's due, you'll see that it says CRS in the background. I took a class on this probably 10, 15 years ago. And it was a CRS class on wealth building. It was the best class that I've ever taken in real estate. Like, so I assume they still offer it. I think CRS changed names. I forget what they call it now. What was that?
RRC.
RRC. Thank you very much. It's a really awesome course, although I'm going to teach it to you right now. So basically what happens is like you go in there, it gives you like what your expenses are based on your mortgage, based on what you're putting down, all of that stuff. Then you have to plug in the property. So the one is that automatically will plug in what is the monthly income. I apologize. I said this incorrectly. That's not your mortgage. That's what you're bringing in every month. So you got to you got to look at the property, and this is where you have to do your job and make sure you do your due diligence. Don't just listen to what the listing agent tells you. Figure out what can I rent this property for? Like, what is a like legit rent for this property? Be conservative. Like, don't plug in like, oh, I could stretch this and make it like, $10,000 a month when they're getting $4,000 a month right now. Like, you're just costing yourself money if you do that. But you have to sit there, and this is where you put your real estate hat on for a second. You have to start to look at, all right, do a CMA, go back to the sales comparison approach. Do a CMA and figure out what could this property rent for, what could this unit rent for within the property, and you have to try to figure that out. That's the part that requires some like thought on your part, because you don't always have those numbers. If you have those numbers, if they've like, let's just say it's a stabilized building, you're buying like a whole apartment complex, and there's market rents there, and they're full, completely occupied, and what the rents are and all of that. Great. You can take those numbers, you can plug them into this and use that as if it's solid. But like sometimes people like to say, I hear this from like landlords all the time, like, we're asking, we get $2,000 a month, but it can really go for $4,500. Like, I just never raised the rent. Like, all right, well, that does nothing for me, because you can't evict that person. Like, you can't raise their rent from $2,000 to $4,500 like this. Like, even when it's not rent controlled, like, good luck. A judge will throw you out of the court. So the truth is like, you got to be smart about what that number is. That number could screw up everything else that I talk about if you get it wrong. So I can't stress enough, don't get that number wrong. Be smart about what you put there and make sure that it's conservative. Any questions, please?
Mike, what is the average rate that you can raise the rent? 3%? Is that correct? A year? Is it different for each town? I'm not sure.
I have had a conversation with attorneys about this, like basically real estate attorneys, where I was like, I had a situation where a property that I owned where the landlord just didn't raise rents forever. And it was not rent controlled at all. And I was like, these rents are so out of control. Like they're flawed. And so I went to my attorney and I said, like, how much can I raise the rent without basically creating a problem for myself? And he told me that there's like two ways to look at it. There's like a 1 year snapshot, and then there's like cumulative. And so the way he explained it is like, you have to make sure that like you can't raise it like 50% in 2 years and be like, oh, it's only 25% this year and it's 25% next year. They'll look at that like that extreme hike. He couldn't give me an exact number because it is something that a judge has to decide on, and like there's like some element of like what judge you're sitting in front of. But he was like, if you raise it over the next 2 to 3 years 25%, you're gonna be okay. So like that was the guideline that he gave me. It wasn't like a 1 year 25%. It was over a course of time. But you may have another attorney that says differently. I'm not trying to say that that's like, that's the holy grail. All right, so moving on this. Vacancy allowance, like if you want to be conservative, bump that number up. I use 10%. I was taught to use 10%. It's kind of held true for me. So, again, it also depends on what you're looking at. If you're looking at like a commercial property that happens to sit vacant a lot, like maybe you increase that number. If you're looking at, think of like office space in today's world. Like office space, I would do a higher vacancy rate. Like whereas like single family residential, I would do lower. All right, number 3, the property taxes. Like, don't try to like get cute with like, oh, I think I can get the property taxes down. Use the property taxes that are in place. Insurance, I just threw in $1,000, but depending on what it is, it could be more or less. Like if you're in Florida right now, that insurance number is going to be a big decision maker. Repairs, I threw in $2,000 and $2,000 for maintenance. There are some years where I don't have to do any repairs or any maintenance. There are other years where I have to do the roof. On average, $4,000 for those numbers, I feel like is pretty safe.
Do you base that on a percentage of the home's worth?
Honestly, it's a single family home, so I just plug that in because I'm thinking to myself like, all right, a roof has to get replaced every 30 years. Like that's probably the biggest ticket item that you're gonna have to do. Maybe a boiler, stuff like that. But like if you average it out, $4,000 a year is a lot of money. Like that I threw in. Like I mean, you're talking about $40,000 over a 10-year period. Like you're not gonna spend that much. I'm just conservative. Like, and if you want to get these numbers to reflect better, lower those numbers. Like and it'll make it a better return. But again, I want to be conservative. Go ahead.
Under your less vacancy allowance, are you including things like the utilities you have to pay there?
So
the
utilities
repairs you have to make.
I don't pay for utilities in this particular property. I push that to the tenant.
Yeah, but
so
it's vacant.
It's a good question, but like honestly, like I don't get that granular.
Okay.
It's like I openly, it's like we're talking about like what is it, $100, couple $100 for the vacancy rate that I have. Like it's not worth even thinking about. Yeah. Any other questions before I move on? Go ahead.
Back to the annual rent increase.
I'm listening. I'm just grabbing water.
Yeah, so I've been told that you can't go over 10% any one particular year.
Yeah, that's probably a pretty good rule.
Then it would be egregious.
Yeah, I mean, if you get different attorneys or judges, you're gonna get different answers to that question. So I just gave you that I was able to. I personally increased my rent by more than 10% on a property that I owned, and I didn't have any issues. But like,
it depends on
it was so grossly under where it should have been that like it still was even increasing it by that much, we were still like practically half of what it was in the marketplace. So it was a different conversation. You had a question over here.
What software do you use to manage all of the properties, like to keep track of everything?
Honestly, like it depends if it's single family or it's like short-term rentals. I actually just switched software, so I don't even want to get into that question just yet because I don't want to give you an endorsement on something that I don't really know. But I have been using, we've been using all different types of softwares for years. Like Guesty is what I was using, but we just switched off of it. And I could do a whole session on that, and I will, but not today. Yeah, I could do that. Any other questions before I move on to this?
Do you keep separate operating accounts for each home, each business?
Well, yes, you should have it. Like the short answer is yes, you should. I don't own a lot of single family residential. Oh, okay. I own 6. most of what I own is short-term rentals, and they're much larger. So like they're businesses, whereas this is like kind of like, you know, I don't need like bookkeepers for this.
Gotcha.
But yeah, I mean the short answer is you should. Any other questions? I'm going to move on. All right, so this is the return that I had on that property. My cash on cash return for year one was negative 5.24%. Now, I don't know about you, but personally, like if you could get 10.7% in the stock market, like, or I could get, you know, practically no return, but some return in the bank, like, you know, year one at negative 5.24% is not good, like at all. That's terrible. But think about it. We talked about a lot of different ways that you make money on real estate. That's just simply cash on cash return. So like, let's just like reflect forward and think about this over time. Like, because yes, that's year one, but does it improve? Like, is that going to be something that's better in year 10? And we'll evaluate the investment as we project forward, because the spreadsheet that I give you doesn't just do year one. It will do the next 10 years and will give you a reflection on over time. So you could say like, what does this look like over time? So if you move through the next tab of the spreadsheet and you think about this from a time perspective, it's going to give you these three things that you plug into a formula. I would highly suggest you copy the three like figures that I put in here. Annual appreciation, 3%. It's pretty average, so I would just use the average. Don't like try to get cute with that. Some people are like, oh, if I put in 10%, it skyrockets. Well, yeah, like it absolutely skyrockets, but like it's not a good way to do this. Annual income increase, 2%. Like it's, again, conservative. The reason why I use 2% and 1% is because your income will increase more than your expenses. Like in theory, that's the way it should work. That's the way it usually does work, and that's pretty safe. So 3, 2, 1 is, I would never really mess with these. If you want to get cute and you want to say like, oh, like I'm buying in this like up and coming market, like, you know, Asbury Park in the 1970s. Like, yeah, like, you know, it would be great, but like the reality is like, how long do you have to wait till it becomes now? Like, you know, and the truth is like, it depends on where you are, but like, I don't play that game. Appreciation to me is king. That's the extra. It's not what I base an investment decision on. So there's nothing to fill in here, but what happens is it just takes my numbers and it projects it over the next 10 years. And it gives me like operating income, cash flow before tax, equity buildup. So my cash on cash return at the end of year 10 on this investment property was 0.17. It took me 10 years on this investment to break even. Like 10 years. I don't know what you think about this, but like when you think of like 0.17 in year 10, like that's a problem. Like that's a big problem. Like, and now if you go further, because that's just cash on cash return, now I look at, all right, I threw in, keep in mind, I threw in appreciation. If you go back a couple slides, I threw in appreciation of 3%, so let's factor that in. Let's factor in the taxes that you get to write off, the interest, all that stuff, because these formulas will do all of it. This is the equity buildup means that I've paid myself at the end of 10 years almost 9%. I've, you know, basically just barely broke even on cash return. And then what it also looks at is like, all right, what's my wealth position, my appreciation, the equity buildup, all of those things. Like appreciation over the course of 10 years, if it goes up 3% a year, is a 33% increase. So it's not just the cash on cash return, it's all these other things that need to get factored into it. This is my first year analysis. I'm just showing you this. There's nothing to do here, but this is like what it'll give you in the spreadsheet. It'll give you your first year analysis, which again is negative 5%. Like it'll also give you a breakdown for, you know, all of these things, these different ways to make money. And that is the detailed analysis too. It factors in like, you know, recovery costs and like, you know, the capital gains taxes and all of those different things. You don't have to think about a lot of it. The spreadsheet does it for you. But then you'll be able to, at the end of it, it'll tell you, okay, my rate of return at the end of 10 years, total rate of return before taxes, is 14%. So like now I know exactly what that investment is after a 10-year period. Again, no guesswork. It's the only guesswork is like, are the rents what they should be, and like what rents am I plugging in? The other is like you figuring out like how much am I putting down and the purchase price. Everything else is pretty much done for you. Just don't mess around with those formulas. All right, so why do I show you all of this? Like, was this a good investment?
Probably not.
Long term.
Right.
Well, we're let's just say we're 10 years in. Was this a good investment? I mean, don't base it off of anything else. Just base it off of this.
Yes.
No, I'm tricking you, but no. The answer is like, think about it. I could put my money into the stock market and get 10.7% a year. This is 13.77% before taxes in 10 years. Like, no. Like, was this a good investment? No. Like, this was an absolute dumpster fire of an investment. Like, it's like terrible return. Like, you should have, like, anybody with half a brain would have been like, don't buy this house. Like, so I tell you that because, like, I didn't buy this house as an investment. I bought this house because I was like, I'm going to move into it. And then I bought it and realized I don't want to move into it. And, you know, which was really stupid. Like, so I want to talk about, there's a reason why this is a setup, but there's a reason why I'm showing. You have a question?
Why did you sell it?
Why didn't I sell it? We're going to get there. All right. So here's the thing. Like, you know, I bought it and I said, you know what? Like, I'll give you the honest answer. I bought it because of the lot. Now, this is what I did not tell you in all of this is I know my marketplace. I know my marketplace like the back of my hand. I live across the street from this house, just to be clear. So I went for a run. I was training for a marathon. I came back and there was a yard sign in the front yard, and I go, you got to be kidding me! Like, you know, like from the time that I left my house to the time I came back, they put the yard sign in. And so I looked at it, and I had never even considered this house. But then I was like, we gotta buy this house. Like, and my wife was like, why? And I was like, well, we could blow out the back. It's a double lot. Like, and I started to do the research on it, and what I realized is it was on for, you know, whatever it was, 600 and, you know, change or whatever. And what I realized at the time was I said, you know, this particular house, like, if you look at everything that is traded, like previously with this size lot, all of them sell for 900 plus. And I said, you can't get this lot. Like, this lot is just very unique. Where it is, what it is, it's a flat property, like it's, you know, half an acre. And I was like, this is just like, this makes sense because of that. And so when I started to like look into it a little further, I realized what I was saying is right. Like, you know, I knew this like off the cuff, but then I started to do some research on the MLS, and I realized like this is $300,000 less than any other property this size that is traded ever. Like for like 30 years or something. It was like a crazy number. Like, or not ever. I think it was 15 years is the number that I looked at. So I was like, Chris, like this makes sense just to, even if we subdivide, you know, if we blow the back of the house out and like, you know, move into it, like it makes sense. But I wasn't viewing it as a rental because I thought we were going to do that. And then I realized, you know what, like I just want to kind of kick this down the road a little bit. So I'm going to start renting it out. And when I started renting it out, like the return was terrible because I just showed you the return. So there's a reason why I'm giving you this particular example for this like session, because real estate, like this goes back to your question before. Would I buy real estate in today's market? Yes. Would I buy it in New Jersey? Yes. Let me show you what actually happened, because this is a dumpster fire on paper, like period. But this is what really took place. So, first of all, a little bit of luck, a lot of bit of luck, a global pandemic, and obviously like, you know, an inventory shortage that is still going on today. So like, what did that do to this investment? I'm going to give you real numbers. First of all, the interest rates dropped from 4.5%. I locked in at 3% at the time. So I refied at 3%, which brought my cost down to like, let's just call it $1,400 a month. So refi from 4.5 to 3, my payment dropped by about $300 a month. Right off the bat, that was this cost savings that helped me. You got to be intelligent about like looking at interest rates and where they are, because it could save you some money. The second thing that happened, my monthly rent is $6,000 a month for $72,000 a year. The rents doubled. They were $3,000, now they're $6,000, and believe me, they're more than that if I put it on the market today. Like, so it increased the annual income by $36,000 a year. I lowered my expenses. I significantly increased my revenue. My cash on cash return was negative 5.24%. My cash on cash return with those two changes went up to 30% a year. It's a pretty big difference.
A lot of luck.
A lot of luck. Thank you, COVID. But the honest truth is a significant difference. Now, if you look at my annual appreciation, I actually did this. I ran these numbers to show you what the appreciation is. The annual appreciation that I put in was 321, going down. It actually was 10% annual appreciation a year, which is insane but true. My annual income increased by 7% a year during the same time frame. I did a 10-year time frame. The reality is less than 10 years. And annual expenses pretty much stayed the same because it's a fixed expense. Like, you fix your mortgage. My taxes went up a little bit, but like not significant. So this dumpster fire, like of 8%, almost 9% equity buildup remains the same because it's a fixed mortgage, so the equity stays the same. But the cash on cash was like, it was negative 5.24%. Went up to 30. It's a big difference. Like, significant in terms of the difference every year. And I just wanted to show you, like, my cash on cash at year 10 was actually almost 100%, whereas there it was like just breaking even. It's a big difference. Like, real estate's a beautiful investment. So when you start to look at the investment analysis, like, and I'm just going to go through these, my future wealth position, I've been offered over $1 million for this house multiple times. I've turned them down. Like, I have no interest in selling this house, quite frankly, ever. But the truth of it is like, some of you may argue, well, why wouldn't you sell the house? Like, you're going to walk away with, $700,000. You could reinvest that in other ways. I could, but it's an asset that I know, I feel comfortable with. I do think that there's a way to actually improve this asset over time and subdivide and build two houses next door to one another. So there's a lot of things to be done in this particular property. But also, like, all right, so if I walk away with $1.1 million, let's say, or $1.2 million, it would probably go higher than that. I'd probably go close to $1.2 million. Like, if I walked away with that money today, what does it do for me? Like, I got to pay taxes on it, and now I have that money sitting in my bank account. I got to go reinvest it somewhere else. For me, like, what I know from this property today is every year with clockwork, like, and this is with the mortgage and everything else, it brings in $30,000+ into my pocket. It's just basically found money every single year, and I still own the asset. To me, I would prefer that. Like, I mean, I'm 42 years old. Like, I'm looking at this and thinking, like, all right, like, yeah, it would take me a long time to recap the $1 million, $600,000. Like, I understand that there's an argument to be made there, and everybody in this room could probably say you're stupid for not selling it. But I also am like, well, what we're not accounting for is, like, it's $6,000 a month today. What's it going to be 20 years from now? Like, what if it's 10,000 or 15,000? Because I don't think it's going backwards.
Your girls might move in. You need to keep it. Right?
Well, that's a whole other conversation. So this dumpster fire is now win for life. Like, and I just feel like when you start to make real estate investing part of what you do, you start to realize that, like, this is not always going to happen this way. Like, it could blow up in your face, and I'm not telling you that it's roll the dice, but real estate's a pretty awesome investment.
Mike, that was going to be my next question. Like, this is a pretty pre-COVID, post-COVID situation. Now, you use those conservative numbers on average because you've invested a lot clearly. Where would you say, it would end up sort of, if you're conservative, is it closer to like 4%? Right? Like, do you know what I'm saying? Like,
well, I told you that I would use 3% is the average that I would use, because I just think that that's like if you look at, it's very easy to look at like what has happened for the last 100 years and make decisions accordingly. 3% is the number I would use. But here's the crazy part. This is the worst investment that I own. Like,
That's
so
not massive, like, yeah, so.
this was the one where I was like, I shouldn't have done it, like made a mistake, was second guessing it, and this is the worst one that I own. Now, I understand that, like, I mean, I started investing really seriously 10 years ago. So it's been a good stretch. Like, you know, everybody could look at the appreciation we had in the last 10 years and be like, wow. But I mean, maybe it's not the worst I own from an absolute number perspective, but it's definitely the worst that I own from a percentage perspective. Like, is probably the better way to say it. So I just want you to kind of like lean into this. Like, happiness is positive cash flow.
Are you selling
Like,
swag?
I'm not. Yeah, they're in the back of the room, $20 a pop. That's actually how I do real estate investment. No, what I'm trying to get you guys to understand is, like, don't like think about this as like, oh, I could buy something that really doesn't make sense and it'll make sense long term. That's not the takeaway. Like, what I will say is everything makes sense over long periods of time. Like, you know, it's very hard to buy a piece of real estate today and to overpay by such a great amount that 30 years from now you're in trouble. Like, it just doesn't happen. You have to get to 30 years from now, though. Right. And that's the part that's like really the takeaway here is, like, you have to be intelligent about what you're doing to, like, you know, how do you survive each year, because you don't want to have to carry a property. And, you know, like, the reality is like, I fortunately didn't have to carry this at all. It carried itself and then some. But what I would say is like, if you were asking me today and I was evaluating this property from a cash on cash return perspective to make a decision, I would not have bought this property. Like, at all, no question, would not have bought it. Like, if you're telling me, like, I'm going to buy you know, people say to me sometimes, like, I'm thinking about buying this property and it's a 3% return. I'm like, don't buy it. Like, and I know that that's like conservative. There's still positive cash flow, but why don't buy it? Because you're going to have headaches attached to the 3%. Like, you're going to get a call, and, you know, I mean, I got a call a month ago, or the hot water heater blew up. Like, all right, I had to deal with that. Like, you never have to get that call with a stock. Like, you know, there are like things that you never ever have to think about when you put your money into, you know, certain investments, and there's a value to that you need to get. Like, so for me, like, you know, if it's a 10% return, like, that's a great return. Like, but the S&P 500 is 10.7%. Like, I would just be very cautious about what you put your money into and try to get the greatest return possible, knowing that there's going to be issues that arise. There's going to be headaches that come out of it. Like, and yeah, like, the market could bail you out. I got bailed out, is the truth. Luck, COVID, and, you know, and lack of inventory. But it's that's not always the case. Like, markets go both ways, and, like, we may have a 6-year period like we have, or 5-year period like we had for the Great Recession at some point. And, like, can you withstand that? So I hope it kind of gives you some insight in terms of, like, the way that I look at this. Everything that I touch for buy and hold, everything has to have positive cash flow. If it does not have positive cash flow day one, do not buy it. And it has to have enough positive cash flow to withstand a change in the market. So, like, for me, I think that if you know that market rates are, you know, rents rather are like, you know, $4,000, I would base everything off of $3,000. So if market rates change, they're not going to go down by more than 25%. But, like, if they were to drop, you still could cover costs. You still have everything you need. And if you do it that way, you're going to be very safe and comfortable and no issues. Go ahead.
It's just another scenario, but I'm curious, what would you do? So say you inherit a property and you are renting that property. It's paid for.
Yep.
So you're making that 30,000 or more, 36,000 a year. I mean, would your mind wonder, should I refi and put that money into whatever 3 other properties, or be content and make that 36,000 a year?
I own probably half of my portfolio in cash. The other half I have mortgages on. I feel very comfortable with that balance. Like, there are some people that own everything in cash. Like there are some people that own, nothing in cash. Like I do think leverage matters. So like I would say that, to have some leverage is probably a good thing. Like, but the way that there is a formula for how much you pull out. Like, you always take like whatever the market rents are, and you do 75% of market rates, and you never want your overall payment to be higher than that number. Like that to me is an easy formula, so not to get yourself in trouble. Now the real answer, that's just a formula that's like kind of a safety measure, guardrail, whatever you want to call it. What I would say though, to really answer your question is it depends on what the alternative, what is the opportunity. So like if you're pulling your money out and you're getting a way better return, so like go back to that cash out refi that I said with my wife, like, when I pulled $125,000 out and it cost me $2,500 a year, yeah, all day, every day. Like, can you always do that? Not necessarily. And also like, where are you taking that money? Are you putting it in the bank? Because if you're putting it in the bank, you might as well just keep it in your house. Like if you're taking that money and you're going out and buying a better investment vehicle, yeah, of course. You have to figure out what the better return is, and it's just like it's just figuring out the math of it. But don't over leverage either. Like that to me is like a recipe for disaster. Like I'm not buying properties with like 99% loans. Like it's just, not that exists, but you get the point. Like, I try to put down 20% minimum on everything that I touch. Maybe some of you don't do that, and that's fine, but like I just don't want to see you get over leveraged.
I thought you have to put down 20%.
To win a bid.
Well, you're right. Usually it's like 25%. Like, but this is the reason why I'm saying it a little differently, and I'll explain. Great question. Thank you for bringing that up. So basically, like what some people do, let's say you own nothing today. Like if I owned nothing today and I was a buyer in today's market, I wanted to be an investor. What I would do is, first of all, a lot of people are like, oh, I'll buy a condo because a condo is like, no maintenance. I don't have to think about it. Like I would never in a million years buy condos. There are investors that's all they buy, but like I don't want to be at the mercy of somebody else telling me about a special assessment. Like I want to know my expenses. I don't want to think about like the HOA fees and how that can rise and all the other crazy stuff that goes on with condos. Some of you guys may feel completely the opposite. This is personal decision, but that's how I feel. If I were a buyer today and I didn't own anything, I was a renter today and I didn't own anything and I was looking to invest in real estate, I would buy probably a 3-family. If you don't have the money to put down a large sum, that's where you could put down less money to buy it, to live in it. So if you're like strapped on cash, like you're paying rent anyway, you want to figure out a way to like improve your situation long term, I would buy like a 2-family, 3-family, something along those lines. I would eventually get to the point where I get the rent coming in that's helping me pay for my bills. Get to the point where you have enough savings to go out and buy something else, move out of that building, rent the unit that you're in. Obviously, use the formulas, make sure that the cash flow's there. Rent it, and now you have that property, and now you're using the money that's come in from that property to buy your next one, because now you've increased your income. If you think of income to debt ratios on, as a purchaser, you're increasing your money, like, from an income to debt ratio, and now you're able to potentially buy something else at, a higher number. And just rinse and repeat that cycle. As you live in there, you move out, you live in the next one, you move out, and eventually you're building a real estate portfolio with potentially less money down. So that's the reason why I said you could do it for less. I don't do it that way. I bought, my first home was a single family, so I didn't go that route. But if you want like a life hack on how to try to do this more quickly, that would probably be the answer. To that point, I want you to think about this, because this goes to, I forget who asked me this before, but asked me about like, Ross, might have been you, like what do you hold on to and what do you put in real estate? I never put myself in a situation where I couldn't afford the mortgages of the properties I owned without the renters paying it. So like, that's something that I think is a big deal. Like if you're buying a single family, there is so much more risk to buy a single family investment than there is to buy a 3-family. it's triple the risk, because the chances of 3 people in a building not paying their rent versus 1 person not paying their rent, it's, 1 person cannot pay the rent. Like, now you have to carry that house. Like, if it's, and good luck getting them out in New Jersey. It's a pain in the ass. Like, so for me, like, if you wanna like decrease your risk, the way you decrease your risk is by buying units that are multiple unit dwellings, because it's just splitting your risk up. Any other questions? Go ahead.
When you prospect a property that you potentially invest in, do you ever consider the geographical location? Like if there's any schools around?
Yeah, always. I don't buy anything that, how do I say this properly? There's no right or wrong to like what people invest in, but like I'm not buying properties that are like, Section 8 housing. Like, I wouldn't knock Section 8 housing. Like, I'm not saying don't buy, like, I'm not saying like be illegal and don't allow it, but like I'm not buying like properties that are low income. Like I'm just not because there's anything wrong with it, but it just doesn't fit my investment portfolio and what I'm looking for. I buy single family residential in, affluent areas. Like, I buy short-term rentals close to the beach or close to some type of an event space. So an event space, like the 2 examples I'll give you is the beach or a mountain that you could go skiing. Like, those are the 2 things that I've purchased so far. Like, I own a farm. That was kind of like, a family thing, but like the reality is the farm has, 3 single family homes on them. Like, we also rent the farmland and like all that. So, I think that the reality is you buy what makes you comfortable and lights you up inside. Like, I heard years ago that if you want to be poor, cater to the rich, and if you want to be rich, cater to the poor. So like, there's definitely like something to be said about like, I have investors that I've worked with that only buy low income housing and like they kill it. They do great. It's just not what I want in my portfolio. Like, I don't want to have to worry about evictions. I don't want to have to worry about like all the tenancy court issues. Like, I've had to go through that twice, I think, in my life, and it's a pain in the ass. Like, whereas, if you think about it, like the house that I showed you, like I have corporate, like, relocating like families that are going there where their company is paying for it every single month. Like, I never have to worry about a check. Like, it's not even being paid for by the individual living there. It's being paid by a corporation that pays me every month like clockwork and doesn't even think about it. Like, I mean, eviction is so far from what I'm dealing with in that instance, like, that it's not, I don't even think about it. Like, and I don't want to think about it. So, I don't want this to come across the wrong way, because there's money to be made on both sides of this. And like, for some people, that's great. Like, part of what I want is less headache. And, that's just, take it for what it is. It's just more like personal preference than anything. Go ahead.
So just to go back on what he was saying about the house hacking for your first-time home buyer, you want to get into investment property, buy a multifamily. What would you say to someone who currently owns their first home, single-family residential?
Yeah.
What would you suggest as a house hack for them to get into investing? Outside of like, cash out refinance?
I mean, at a certain point, you just have to save up enough money to just put money down on
Sorry.
Are you telling me to shut up? Have I reached my quota?
I didn't think I had any alarms on.
No worries.
Sorry.
What I'll say about this is, like, at a certain point, there's ways to invest in real estate that you could put money into if you could get to the.
I just shut it off.
All right.
Can you go back to just the end of the?
Yeah. So the question was like, how do you house hack? Like, how do you buy more investment properties if you own a single family and you can't do it that way? I mean, at a certain point, there's not like a perfect answer to this. Like, if you really can't afford it, but like maybe you could do the sweat equity piece and all that stuff. Like, maybe you find a partner. Like, so that's something that could play a role. Maybe you buy in a different marketplace, like, where you could afford it. Maybe you just save money to the point where you could put a down payment on, whatever it is. Like what I would strongly suggest is if you don't own anything today, I would buy a multifamily. Like I would buy a residential multifamily because I just don't want to see anybody in here get caught with like the tenant doesn't pay and now you're in trouble. Like, because to try to carry multiple mortgages, like that's the fastest way to go to bankruptcy, like, you know, and foreclosure and whatever else. So to me, like if you've never been an investor and like you don't know what you're doing, like that to me is where I would start. It just like, it lowers your risk. Like, and you know, where you buy and everything else, like there are REITs and there are like different like opportunities to buy real estate that you don't own. I don't really do any of that stuff, but like you could invest in real estate by putting $100, you know, a month into real estate, but like, you know, investing in these portfolios that exist online. I've never done that. I don't really know about that world. I mean, I've looked into it, but it's just not something that I like. I want to own it. Like I want to actually own it.
Just one thought on your question. If you're asking, you have a single family home, how can you house hack? You know, maybe start with your town to see if you can create an apartment in your home that's rentable. Like, I have a legal.
It's a great answer.
And I am allowed to rent that in Morris Township as long as I have a room into my house, as long as it meets certain requirements. So
I know certain towns
the prior owner turned it from an office into a mother-daughter through the town, and I have a board approval showing that that's permitted, so I can rent it out, and I do. And so maybe you can house hack your house, check with your town. It's a game, it's a lifesaver.
ADUs are getting
ADUs
everywhere.
Yeah.
It's a trend. It is.
There's no question about it. That's not the first thing that came to mind, but what I will say, it's a great answer because the truth is like, one of the biggest hacks in general is if you're able to create more uses to a property. Like one of our things that we look at as real estate agents, we should, is what is the highest and best use for a property? Like, and if you're not thinking that way and you don't have that lens, like you need to have that lens. Like what's the highest and best use for a property? If it makes sense to have a different use, try to get a different use. Like, and I'm going to give you an easy example, and maybe I'll talk about this at some other, you know, session moving forward, but I have a building in upstate New York where there's a downtown and we have like a multifamily building where it's 2 units, 2 apartments, and then there's a downstairs unit. And the downstairs unit, we were having a really tough time renting it because there's just not a lot of businesses up there. It's not like that type of place. Like we could rent it out to like let's just say like an attorney, but you're gonna get like $500 a month. It's like, what's the point? Like, so it just didn't make a whole lot of sense. So we had to be creative about how we created the use. And one of the things we did is we created like a clubhouse for all the other units that we have there. So we put like arcade games in there, and we put like, you know, a pool table and, you know, a big screen TV where you can watch a game. And we literally like use it as a rental, like an additional rental for the units that we have, because there's just not a lot to do up there, like besides going skiing and like, you know, going to the bar. Like, so for us, it's like, well, hey, are you interested in renting this other unit? We make way more money off the clubhouse than we do if we were renting it to an attorney. Like, you know, it just makes a ton of sense. And it's gotten to the point where like locals rent it out if they want to have like a birthday party type of thing. Like, so, you know, you have to just like view it that way, as like try to get creative with the use if you can. I saw a hand. No? I want to do one more thing before we like break here. If you have questions, I'll certainly answer them. But let's play Match.com. So, and I would love for you guys to participate in this. And by the way, the goal is to try to actually like do business while we're here. So that's very simple rule. So the rule is everyone in here needs to decide on their primary role. Like you can only pick one. I don't care if you fit all 4 of these. You have to pick one. So the role is you're a deal finder, which means that you're people with access to on and off market properties. You're a capital partner. That's somebody with access to cash, a HELOC, 401k, rollovers, private lenders. Next one is operators. You like to do rehabs, you know, you do management for properties, short-term rental operators. you're construction savvy, or the fourth one is you're a learner. Like you're a future investor, you want exposure, you want mentorship, sweat equity, what have you. Everybody got that in your mind, what you are? Yeah, you know your category? So here's the script, and I want you to stick to the script. I'm whatever your name is, I play the role of whatever your role is, I'm looking for whatever it is, and in whatever market. So I'll give you the first example. I'm Michael Pennisi, I'm an operator, I'm looking for fixer-uppers in Union County. What I want you to do is, anybody who's willing to shout this out, stand up and kind of do who they are, what I'd love to do is if you get a feel for the people in this room, there might be somebody that's a match for you. And I don't know who that person is, but if you hear somebody who's a match for you, anybody who's willing to do this, I would appreciate it, then write their name down and seek them out after this session. Because if you have somebody, if you're an operator like myself, every person in here knows that I'm looking for fixer-uppers in Union County. If you have a fixer-upper in Union County, seek me out. Because I would love to hear about investment opportunities because I might be your buyer. And I would love for anybody in this room who has a want, a need, or what have you to just shout it out.
Can you go back
Yeah,
to
can
the
you go
other
back a
screen?
second?
Can you do a split screen?
I said, does everybody know what you are? Learners, future investors, operators. Operators are like, I flip houses, I buy and hold houses, I do short-term rentals, that kind of stuff. Capital partners is like, you have the cash. Deal finders is, I can find off-market properties, that's something that or I have an off-market property. Like, and by the way, if anybody has something that you want to shout out, that's the one exception that I'll add to this rule, is if you have a property that you feel would be good for investors, shout it out. Go ahead.
Okay, so full disclosure, the reason I came here today was because I went to see a property yesterday. It is an old school that's abandoned.
Do me a favor, stand up and speak loud.
Hi, Jason Thompson, Coldwell Banker Maplewood.
Now we got it.
So I came here today because I wanted clarity, and just because I'm an investor, I want to grow. I went to see an old school that they're saying can be converted into 12 to 16 units. I've never done anything of that magnitude. I have short-term rentals, I have investment properties, I have multifamily, but I'm like, I want to go bigger. So when you pull that up, I'm not sure where I'm at because I'm like, I could be 3 of them.
That's why I said pick one. But no, in all honesty, if that's the case, I would probably put you here. You found a deal. Like you found a deal and you're looking for somebody to potentially do the deal with or bring you the cash or whatever.
Well, so my concern is I don't know if it's a deal yet because of the numbers. I don't know the numbers on
Well,
something.
I just gave you the whole formula.
On that scale, I don't know what it would cost to rehab something of that magnitude.
I understand. So actually, I'm glad you said this. And I'm not picking on you. You know I love you. So I think that the way to look at this is you probably do need an operator. Like you need somebody who could give you real numbers. Hold on one second, Kim. Kim's like, I'm an operator. That's great, matchmaking. But what I would say is you need an operator because you need somebody to come in and give you advice on what the construction costs are, who's done a project like that before, who feels comfortable with that. That's part of the reason why we're all here. And quite frankly, I can tell you, like, you dive into this. Like, you do an investment, you find a partner if you need a partner, and then you learn from your partner. Like, and there are things that you pick up along the way where you're like, wow, I didn't know how to do that before. I never thought about that before. And that's a big part of what this is about. I don't want this to just be like Growth Mastermind where it's me or a bunch of speakers speaking. Like, I want this to be more of like, hey, what are we working on? What do you have that could make sense? And by the way, there may be somebody who shouts something out today that, like, I'll use myself as the example like I just did. Like, like, I'm looking for fixer-uppers. Like, maybe you don't have something today, but between now and our next session, maybe you find one. And now you know, hey, like, Michael's interested in that. Like, the reality is every person in this room has a value, and you have to decide, like, where you're going to fall in all of this. And I'll be honest with you. Like, I could find deals. Like, I have cash at times. I'm certainly an operator. Like, I'm also a future investor. Like, I'm always looking to learn and grow into different investment vehicles. So, I fall into all these buckets. It's just like, we can't talk about all of them today. So it's more of like, what do you feel you want to shout out? Go ahead.
And just one of the groups that I'm in drives this home to us all the time. You should be looking at 100 deals before you buy one. So look at that school, dive in, run these numbers, and it may be a negative cash flow, but he's like, how many deals did, people saying, I can't find a deal. I never find a deal. Well, how many did you look at? How many did you run the numbers on?
And I do that. I will say that, I say no to more deals than I say yes to. Way more deals than I say no to. And I'll do my due diligence. And sometimes I've said no to deals where I've had partners where what are you kidding me? You got to buy this. And why are you not looking at this? Why do you not care? And I'm like, I know there was a house down the street from me. It's actually on the same street as Madison Ave. And I had the opportunity to buy it off market. And I was viewing it as something that I was going to live in. And I was like, nah, I don't want to live there, and didn't buy it. And it traded for $500,000, at the time that I said no to it. It was immediately cash flow positive. Why did I not buy that property? It was just absolutely idiotic. And quite frankly, I would have tripled my money on that property. But I had one lens on, and it was do I want to live in this house? No, I don't want to live in this house. It's out. What I'm trying to get from every person in this crowd, and what I want you guys to really start to think about is there's not one lens. There's a flipper lens, there's a buy and hold lens, there's a change the use lens, there's a short-term rental lens, there's a, can I add, this onto the property? Can I knock down this wall? There's so many ways to think about how you invest in real estate. And my goal for Reinvested and what I'm trying to get to is I want every person in here to build a repertoire of different lenses that you can view the world in. And, we're going to keep adding to your skill set every month as we do this. But I also want you guys to do deals. That's ultimately a best case scenario is if you walk out of here and you match make with somebody, you could win. But it requires your involvement to do that. Go ahead.
No, I was willing to do this.
Please, go to work.
All right. My name is Louis Randolph of Maplewood. I play the role of, and I choose today as an operator. I'm looking for right now anything from fix to flip in both Essex, Passaic County. Those are the markets, and just to give a backdrop, I've been doing it for 7 to 8 years already.
So Louis, I'm going to call you out because you volunteered. So Louis, you've done tons of flips at this point. You invest in buy and holds and everything else. So you talk about an operator. He's somebody who lives it every single day. Is that fair? Yep. Kim, you raised your hand before. Can I go back to you? Please, shout it out.
It was actually just what he said, but he could be the operator. I could watch.
Just to be clear, there's probably 20 operators in here, but Kim would be another alternative operator. Where would you be looking to do it?
Where would I be looking to buy?
Where would you be looking to work?
I mean, I would probably still choose Union County.
Union? Okay. Awesome. Who raised? We got a lot of people. Just shout them out. Jump out. Whoever wants to go next.
Well, I'm Janet Painter from the Short Hills office, and I would be an operator too. I'm looking for condos either that need rehab or Morris.
Please go ahead, you guys. Just shout it out, please. Yeah.
So I'm a deal maker. I'm gonna find you properties.
Stand up. Say your name, please.
I'm Lisa Zaccardi. I'm from the Ridgewood office, but I live in Passaic County, so I can do Essex, Passaic, Bergen County. So that's what I do.
All right.
I'm here to help you find the properties that you want.
Go ahead, Kate.
So,
I'm Kate, from the Maplewood office, hi. And for the purposes today, I'm a deal finder. I have 2 properties that fell out of contract from a bad faith buyer in South Orange. They bring in about $23,500 a month, and he just reduced the price, so let me know.
What is the price?
The price for both properties, one's a single family 11-bedroom house that's a student rental, brings in $9,500 a month, and one is the last legal rooming house in South Orange. There are 11 leases on the property that brings in about $14,000 a month. It's 120 and 122 Milligan in South Orange, and they're good. I have all the info. So Kate Elliott, contact me.
Are they on MLS?
They are on the MLS.
Are they under management?
The owner manages them.
Would they check out at the price point?
They check out, baby.
I knew they would. Go ahead. Thank you, Kate.
Well, hello, everyone. My name is Elton. I'm with Quintessential Mortgage Group. Technically, I'm a capital partner. I do have direct experience with investment lending, such as DSCR programs, and so If anyone has any questions about the technicalities of getting an investment loan, I'll be more than happy to help.
Awesome, love it. Go ahead.
I'm Jessica with Coldwell Banker Realty, Monmouth, and I play the role of deal finder, and I'm looking specifically for future investors and capital partners who are looking to invest in the Fort Monmouth area. Netflix is coming to town, and the word on the street is that we need places of leisure. So anyone who's looking to rent commercial property, we need pizzerias, we need fun things to do for all of the new people who are coming to our town. So if you know anyone who has a really cool spot that they want to rent space for, or maybe a pool hall or a clubhouse like this, or arcades, and
I want to learn more about this. You think I'm kidding? I'm not kidding. I own a lot in Monmouth County.
Jessica, I'll give you my card.
Jessica?
Yeah.
What's your last name?
It's long, I'll give it to you.
Oh, see, we're matchmaking. Go ahead.
Okay.
Betsy Melita. My husband is a contractor and I'll say a designer. We work in the Durham Park, Morristown, Madison area. We're looking for investors at the moment without the technicalities of DSCR.
Awesome.
We do luxury homes and welcome any investors that is willing to put their money to a good use. We reliable builders. Thank you.
Awesome.
What's your name again, sir? Betsy Belida.
Go ahead back there.
My name's Megan. I'm in the Middletown office in Coldwell Banker. I'm a learner, but I'm looking to meet with a dealer. I have a couple of relationships with some house flippers, and I'm looking for off-market deals for them, because anytime I bring them something on market, it's just not interested.
Okay. Hey, I appreciate the fact that you said learner. Not everybody says that, so that's great.
Joanne Santiago with the Ridgewood office. Hey, Lisa. Also a learner, definitely. I am also a deal finder. Currently have an off-market property in Irvington. Had to take it off the market 6 months ago. It was cash flowing. Removed the one tenant, so could even cash flow even more, even with Section 8. Actually pays more than market because it is in Irvington. And then the basement, the owner can be very creative and do what they want with it. I'll say that for fair housing purposes. It's a 2-family with an exclusive driveway and a detached 2-car garage, right between the Parkway and 21. So it's actually a really great location, good for buy and hold, easy cash flow.
Awesome. Anybody else? No? I appreciate you. Go ahead.
I do have a question.
Yeah, please.
So my name is Denise Vanez, and I am from the Maplewood office. I'm definitely a learner. I'm 100% clueless, so I'm just,
You're not
taking
clueless,
everything
but go
in.
ahead.
But I do have access to a lot of investors that have access to cash. And so if there's ever a deal and it's a good deal and I present it to them, I would want to know how that can come together as far as like if it's an off-market property and someone else finds the deal and I have the cash.
Yeah, I mean,
rather than-
it's. I would come see me directly, but the reality is like, just in general, the whole point of this is matchmaking, and what we would do is we would figure out to, a lot of times if it's off market, we would have a buyer agency agreement signed with that particular investor, get them access to, it could be specific to that property if need be. But we would set it up so you have all the documentation to make sure that if they buy that house, you get paid. Okay. And then the details of like how to actually guide them and all that stuff I talked about a lot today, but if anybody needs help beyond that, like obviously reach out to me, reach out to your managers. Any other questions that we have? Anybody else want to talk? Please.
I'm Jesse Davis.
Yeah.
I'm interested in finding out financing for rural properties just sitting 5, 8, 10, 15 acres. Is anybody here that does that or have?
For land specifically?
Yes.
Okay.
In the state?
In the state of New Jersey?
Do you do land?
Yes, it's in Sussex County.
I don't think I do land.
Yeah, I don't know. I personally don't know of any lenders that do lands. I'm not saying they don't exist, but I don't know about them. Wait. I apologize. I didn't catch his name. Jesse. Kim back there has a lender that does lands purchases. So make sure you guys connect.
Did you say you were going to give us the spreadsheet somehow?
I am. We're getting to that right now. So did you wanted to add?
I had the same question. How are we getting the material from today
And can you tell us what the next topic is gonna be?
I wanted to actually ask you guys that question. I'm just going to flip this back around for a second. All right, so for how to get the slides, you're not going to chase me around, I promise. First of all, thank you guys for coming as always. How do I get the slides and spreadsheet? See? Prepared. Really simple. Go. Everybody do this right now. And I'm not giving you the slides unless you do it this way, so don't even ask. Just go to my Instagram.
Follow you?
Out of the way, I apologize. You said, can I step aside? I didn't realize it was me. Go to my Instagram. Once everybody's there, I will tell you the next step. If anybody's not there, you got another 30 seconds. Otherwise, we're moving on.
People's heads are in the way,
What?
that's the problem.
Stand up.
We all good?
Yep.
Yes?
You just gotta walk up.
All right.
Yes,
If you go to my Instagram, you're just going to comment on any photo that you see and just put in start to invest, spell it exactly that way, put that in as a comment, and it will send you the slides. That's it? That's it.
Any pick, he said.
Get a picture, right?
Pick the one. You know what? Pick the reinvested one. I just put it up. It should be the fourth one there.
Good job getting engagement.
If you go on there, it will send you all the slides. It'll also send you the spreadsheet. It's gonna just what it is. It's a link to the Google. It's a link to a Google folder, Google Drive folder, and it has both the slides and it has the what's it called? Spreadsheet. If you guys have questions about anything, like I'm going to put this recording out online. Please go ahead.
I did have a question. I'm just curious about how you feel about wholesaling.
You gotta get off the car.
Oh,
I know, because that's how I feel. I'm just personally curious. Your thoughts?
Go off that.
All right, wholesaling. Yeah. This is a little bit of a loaded question because I'm going to talk out of both sides of my mouth. I personally hate wholesaling. Hate it. Like hate it.
And wholesalers.
I don't want to say I hate wholesalers because listen, everybody's got to hustle. I don't feel comfortable wholesaling personally, but I guess so for those of you who don't know what this is, wholesaling is like I go out, I sit down with a seller, they want to sell their house for $200,000, but I know it could trade for $400,000, so I buy it for $200,000 and I sell it for $400,000 before I do anything. Like, I just feel like that's like icky to me. Like me personally, it depends on where the property comes from. Like, so if you're buying it from a bank and you're wholesaling, I don't really care. That's fine. But if you're buying it from some little old lady who doesn't know any better, I don't love that. I don't do that. But the only time I would wholesale, like, is if you buy it. Like, let's just say you buy a property and for whatever reason your situation changed, or you just, you want to put your money in a different investment and you just want to get rid of it quickly. Like, I understand that's a different conversation, but I just feel like we as real estate agents, most of the people in this room are real estate agents. I don't like to self-deal. Like, I don't feel comfortable with like trying to, to take advantage of somebody knowing that I know the numbers. The way that I would do that, and I would feel comfortable with what I'm about to say, is to tell them straight up, listen, I am not working with you in a capacity of a real estate agent. There is no fiduciary responsibility here. I'm interested in buying your house. What do you want for your house? They give you a number, you give them their number, and we move on. Like, there's nothing wrong with that. I'm not saying that you should overpay for properties, but I just think that like when you get into the wholesale business, people do some weird things to try to like manipulate the process, and I don't like that. I will say there's a wholesaler that I know, Kate, you know the same guy, who I love. I think he's like respectable. I think he treats people the right way. I think he's above board, like ethical, however you want to say it. Few and far between. Like, I think too many wholesalers play games with people, and I'm just not a game player. And like, I don't like a lot of the manipulation that goes into wholesaling. What was that? No, you're
Every
good.
time I put on your Instagram, it plays Bon Jovi. I can't get it.
On my Instagram? Do I even have Bon Jovi on my Instagram?
So he should be in my.
What else did I want to finish with? I already told you, subscribe if you haven't. It'll just give you all this content. And if you want the video from today, it's going to be on there. I'll put it up as soon as I can get it up. Upcoming events. I talked about this a little bit. I just want you to understand like a lay of the land here, because a lot of people like ask me about this. I'll get to you in 1 second, Louis. So the conversation, I do this with two of my buddies from around the country, Cyrus and Juan. And this is all about like, it's real estate strategy, but it's really tech focused. So if you're interested in like today's technology and how to drive traffic and all that stuff, like to you, this is kind of the channel for that. I will tell you, we had a really great session the other day that I did with them. It's up online already. I already put these things up. That was like the tech stack for 2026. And then I did one before that, which is like social media driven course. We do these once a month. They're all online. Go ahead. Yeah.
Are these on YouTube or Instagram or both?
These are on YouTube. The Instagram, I'm just pushing people to Instagram just for the slides themselves. All the videos are on YouTube. They're just on my YouTube channel, which it's basically like QR code, and then just subscribe and you'll get them as they come out. I'm doing this intentionally because people chase me around for content all the time, and like I just don't do it. Like if you want the content, like use one of the channels that I give you. Otherwise, you're not going to get it because it's just too much to do it with 100 people. So this is, like I said, what we're doing once a month, and it's really tech focused. Growth Mastermind, we've had some unbelievable speakers. We have some really great speakers coming up as well. So if you want to grow your business, your real estate business, leadership, productivity, that's what this is. And then the next one for reinvested, I'm just going to put this, I'm going to put this slide up so you get all three. But I want to actually ask you guys a question. This is the last question I have for you, and then I'll answer any questions you have. But I'm curious, what do you want to talk about from an investment perspective? What do you want to learn about? Because I can go in a lot of different directions, and I want to make sure that I give you what you want.
Property management.
Property management?
Flips.
Flips? What else we got?
Well, how many
Analyzing
investors do
someone's
we have
actual
here?
deal.
Analyzing deals?
Let's
Okay.
say more
Just shout them out. I don't want to.
Analyzing deals.
All right, maybe we don't shout them out. Go ahead.
So, analyzing more deals. So we should be so comfortable with that spreadsheet. We
Yeah.
can help ourselves or any buyer.
Yeah, some of that, like, I'm not going to go over the spreadsheet every time because honestly, it'll get boring. But I think you just need to practice it.
Yeah.
But what I will say is, if you, between now and next month, if you're practicing it and then you realize there's something I don't understand, bring it. Like, and I'm happy to answer questions specific to that. Go ahead.
I was gonna ask, how do you, I don't know if you've ever done this, sourcing for funds from capital investors
Yep.
to do flips, and then in return for that, what's the normal or the usual percentage you would pay?
So that's a moving target. I'm in your way, I apologize. That is a moving target. So the question is like sourcing for funds. So like, how do you work with investors? I've done deals with hard money. I've done deals with banks. I've done deals with, what do you call it? Portfolio lenders. Everything under the sun. So, we could certainly talk about the funding and lending portion of this. That's not a problem. But the numbers themselves, like what percentages you pay, like that's market driven. So it's kind of hard to say like exactly what it is. It just depends on what it is today, and it might be different a month from now. So I could speak to it a little bit, but like the reality is like that's going to be something that's not always the same. Go ahead.
If you decide to do a joint venture with someone and you have no experience, what
partnerships and all that.
like what should your percentage be because you don't have experience in that and you're learning?
So like how to actually structure partnerships.
That's great.
Okay. There's a lot of directions to go in on that. That would be a hard one for me to think through, but I could figure it out. What else we got? Anything else? So we got flips. We have. Go ahead.
What? How should you own the properties? In an LLC or personally or?
So the business side of it, like how do you actually like structure the deals and how do you, or not the deals, but how do you structure the ownership? Okay.
Pros and cons.
I could go into that. I mean, listen, I could also feature other speakers. Like we get an attorney in here, we get lenders, like all that kind of stuff. Go ahead.
Like 1031 and like tax implications.
1031 exchanges. I'm gonna do cost segregation, which is very much for anybody in here who makes money on on real estate sales, which is most of the room. That's probably the best conversation I could bring to you is cost segregation, and I'm pretty familiar with it at this point. I've done several of them, so we'll talk about that. Anything else? Go ahead.
Short-term rentals.
Short-term rentals. I mean, I could have a field day on that. So.
So if you want to become an operator, how do you get into the business?
How do you become how do you go from one to the other?
With very little capital, how do you get creative with capital raising
Okay.
or funding the project?
Yeah. That's probably the hardest question here is like, how do you like make something out of nothing type of thing? Like, you got to have some place to start with the capital. Like, it's just like, there's got to be something that you put into it. But we could talk about like how to get creative on that front.
I don't know if this already falls into something that somebody has said, but like in your example, right? When you're locating something like a deal, okay, where do we go for the resources to find out, hey, how can we split this lot? What's that potential?
Okay. So like how to subdivide and how to like understand highest and best use. Okay. By the way, I'm not saying that we're gonna like run with all this next month, obviously, but what I will do is I just wanted a series of ideas because quite frankly, like I want to bring you what you want to hear about. So I think that because it's just so common, what we'll talk about is a little bit on flips next month. That's just like an easy one for me to kind of start with and, just to get rolling here. And then, we'll dive into some of these other topics, over the rest of the year. Okay? You good? Thank you guys.
Yeah.
Thank you. All right, I have a couple of requests. Take bagels. I don't drink coffee, so take coffee. And really, I appreciate it. If you guys had a good time today and you learned something, invite your friends. We'd love to have whoever wants to come. Thank you, guys.